So it's been quite a week in the stock market. The head of the Federal Reserve saying that rates will remain high for a very long period of time. And then the next day you have the Bank of Canada saying that they're not going to be increasing interest rates, which the market liked. And then on Thursday and Friday, we get news that a bank in the United States has completely gone under. The bank in question is Silicon Valley Bank, and it marks the second biggest bank collapse in U.S. history. So this Silicon Valley Bank, nearly half of venture-backed startups in the United States. Its clients include 44% of venture-backed tech, and so essentially you're looking at, startup companies, technology companies in Silicon Valley. And they said that at the end of December, they had about $209 billion in assets, making this the second largest failure of a federally insured bank in the U.S. history after Washington Mutual, which collapsed during the financial crisis back in 2008. So this is the largest collapse in history since the financial crisis. So, why did this bank go under? So essentially, you know how when a bank has your money in it, it usually invests your money to make a return. That is the whole basis of how banks operate. They take your deposits and they make more money with your money, and they put it in short-term treasuries. So they were holding a high number of treasuries and other government bonds, amounting to more than half of its assets, which seems rather risky. And then our friend over at the Federal Reserve, continues increasing interest rates. So these long-term bonds that the bank was buying are worth a lot less. And why is that? Well, because if they get a bond that's paying, 1%, 1.5% over a 2-year or a 10-year term, right now you can buy a bond that's yielding 5%. So the value of your bond that you buy that pays 1.5 has to decrease, because nobody in the right mind would pay the same amount for your bond that's yielding a lot less. And then on Thursday, their shares tanked 60%, and the bank said it sold $21 billion in assets and planned to sell some of its stock to raise money. So this is what really spooked the market and really started the bank run, because the disclosure sparked panic among tech investors and company founders who encouraged startups to withdraw their money. And then essentially everybody tried to withdraw all their money from the bank at once, and well...
What do you mean the bank is out of money? Insolvent? You only have enough cash for the next 3 customers!
And as a result of this bank failing, you have the American market selling off out of their banks, and then you also have the same thing happening to a lesser extent to the Canadian banks. So one thing you want to keep in mind is, why did the bank fail? Well, they weren't diversified, so they were not diversified. They just had all of their eggs in one basket. Most of their money was in, tech startups, money-losing companies. It's very likely that they would never get paid back on a lot of loans that they issued. And also, they really did not manage their liquidity very well, because they had pretty much the majority of their money in bonds that were yielding very low rates. And then as interest rates rise, the value of the bonds that the bank buys decrease. And if people want to take out their money, they have to sell these bonds at a loss. And, they can't wait 2 to 10 years for these bonds to mature, where they would not incur a loss. But if you sell out before the bond matures, because you kind of have no choice, the bank can go under. And this is the real risk that a bank can face. But I'm not worried about, the Canadian banks, because they have a lot stricter regulations. So with that said, we are at 20,571 across both my RRSP and TFSA. So if you want to follow along with my buys and sells from week to week, please like the video, subscribe to the channel, and let's go into my TFSA. So in the TFSA, we have 19,609.14, so we're down 3% on the month. Just this week, we're down 4%, and then in the all-time, we're down 4% or down 909. And a lot of that is due to a decline in the financial sector, which I do have a good amount of money in. So if we go into the portfolio, I purchased one more share of Brookfield. So we went up from 24 to 25. This one went into a major dip. So down 18%. I'm very happy getting more shares at these levels. I was also considering getting more Aritzia, but we're still in the green on that position. If it falls a bit more and I'm back in the red, I'll definitely be interested in adding in that position. There's just a lot of opportunities in a falling market. And honestly, the sell-off is making me very excited because there's just so many different opportunities in the market. It's just a matter of picking what you think will do best and staying level-headed and, having conviction in your picks. If you don't have that conviction, then, maybe you should reconsider what you're investing in. And then another development is that Intel actually completed development of their 2 nanometer and 1.8 nanometer, and they're going to start producing it in 2024. So this is actually huge news and a very positive sign for the foundry business, because if they can complete these, assuming that they don't have any production problems like they faced in the past, this really sets them up to be a threat to TSMC, which is their major competitor. And if they can catch up or even beat TSMC and go to a smaller die, a smaller node before TSMC, then yes, they can take back the lead in chips and really profit from the foundry business in the future. So very interesting news for Intel shareholder. I was actually very happy seeing this article. Very low key, very underrated piece of news, but one of the main reasons why I'm invested in this stock, and I'm very excited to see how this turnaround plays out once their investment phase is over and the foundry business will just start raking in the profits off of all of its clients. And then with Microsoft, I just purchased a little bit more with the dividend, so just reinvested that right back into Microsoft, so just a little over $3. With Smart Centers, we actually purchased one more share, so we went up to 44, so this is yielding almost 7% right now, so pretty good time to be getting more real estate. And I purchased one more share of TELUS, going up to 51. So I've bought 3 shares this month so far, and I've committed this year to purchasing 4 shares of TELUS every month to double my share count and have myself be able to purchase a lot more TELUS with my dividends. So I want to be able to buy a share with my dividends from TELUS. So we're approaching that goal. And then with the banks declining with the bank run of that American bank that failed, we have TD and even Scotiabank dipping tremendously. Like, TD does not usually dip this much. So I really am considering adding more to my Scotiabank and TD position. And the position that I'm thinking of selling out of is just POW. I think this is a really great opportunity to load up on BNS and TD at this point. So I think I'm going to do it on Monday. And, you can let me know in the comments below what you think about that. But I think that this is a great chance to take advantage of fear in, our banking system as a whole. Just because POW's held up a little bit better than TD and BNS. And I'm thinking of selling this position and just deploying that $1,000 across TD and BNS. And if we go to the dividends earned, we've earned $12.2756 all time. If you've watched all the way through, thank you so much for watching. Please don't forget to like and subscribe to the channel. And if you are new to investing, there's no better time than to start investing during a market sell-off. So feel free to use my link for WealthSimple in the description below. And if you sign up and make a deposit, you can receive up to $3,000. And then our annual dividends went up from $9.65 in the previous update up to $9.70.27. So, almost an extra $5 a year. Not too bad. The monthly average dividends went up as well from 44 to 86. Weekly, we increased our weekly income by 10 cents a week. On the daily, an extra 2 cents a day, 264 to 266. No change in the snowball effect of how I'm tracking how long it takes to earn $100, and our portfolio finally went back to earning 47 cents an hour for a 40-hour work week, so a little bit of a raise there. And year to date, we have earned $221.84, so we've almost passed our entire 2021 dividends. So there's some nice progress in the portfolio so far. And, you know, with that bank collapse, I'm really going to focus, especially if the Canadian banks continue to fall. Like, I will continue just getting in some fractional buys here and there. Even though they're already large positions, I mean, if the price is going to decline, since they're kind of a forever hold for me, I'm just planning to hold these stocks until I retire. This is a great opportunity to get some Canadian bank. In the comments below, just let me know what your favorite Canadian bank is. All right, have a great day, everybody.